Hi everyone, thank you very much for being here. I see that this conference has success because when I see as many people in the auditorium on a Friday morning in Paris, not counting everyone, by teams, this is testimony of this success. Again, thank you very much. I think it's the second day of this SSA conference. I was told that there are more 20 countries involved, more than 30 issuers, more than 40 investors. And I was told that there's going to be, or there have been, close to 300 one-on-one. So I guess this is a testimony of this success. Thank you very much. I guess I'm there to introduce the first panel that we will have. And I guess, following, Eric Lombard yesterday with, the French Ministry of Finance, we are very honored to have Philippe Lane here today. I'm sure everyone knows, Philippe, I guess, as an ex-head of the Irish Central Bank, I guess, on the executive board member of the ECB and in charge of economics and monetary policy. So I guess, Philippe, thank you. Thank you very much for being with us. I'm not going to, talk about your CV, which is as long as it can be. But again, very important. And I think that in the world we are living, with all the questions we do have around monetary policies around the world, I think it's it's really great to have you here. Also, thank you, Alain Durré, who's our Chief Economist, to have organized this session. So again, I will not be long. Again, thank you very much for being here. And I think now the most important part starts with Philippe and Alain for this discussion. Thank you very much again. And thank you.
Thank you very much, Michael, and good morning, everyone. I'm Alain Durré, heading the EMEA macro research, and thank you for being here today. So then, of course, we will talk about monetary policy, but not only. And thank you for being here, Philippe. So very nice to, I'm pleased to have you on board today. And well, my first question will be, given the fact that you had the Governing Council meeting last week, so how do you see currently the economic conditions in the euro area?
So maybe I'll bring you back to a year ago. So a year ago in June 25, we brought the policy rate down to 2.0. And if you were listening to our communication second half of last year, first months of this year, there were phrases being kind of attributed to us, basically saying the ECB's in a good place, the euro area is in a good place. So we had at that time, before the war, inflation more or less around our target, the European economy growing steadily, and also the European economy being supported by domestic drivers of demand, which has not always been the case. So in other words, it was a pretty steady picture before the war. And then since then, we've had this new shock. And when it arrived at the end of February, it's right before our March meeting. So we had an initial analytical response in March. We also looked again in April. And by June, we essentially had enough accumulated evidence, first and foremost about the fact that the war had been on for 4 months. So essentially, again, no matter what, and again, of course, we've seen some improvement this week, there's enough cost increases in the pipeline that we think inflation will be above 3% the rest of this year, relatively high at the start of next year. And so if you have a year of inflation well above our 2% target, that has knock-on effects in terms of energy-using sectors having to raise prices, the cost of living going up, which puts some upward pressure on wages probably next year. And so if you look at the fact we did have an increase in our expected inflation rate for next year, And then maybe, Alain, importantly, we've also seen what's happened to the economy in these months. We do think the energy crisis hurts the European economy, but we also think there's a fair amount of resilience. So let me list the resilience factors. Number one is essentially after our previous tightening cycle, after the rebuilding of personal income after the inflation shock, we do have an engine of growth from consumption. And even with the higher inflation rate now, we have household real incomes going up this year, next year, the year after. So that's a foundation for consumption. For investment, we still had the past tightening cycle dragging on investment in 2025. That's out of the system now. So we assessed, for example, housing investment should be good this year. We have also, because of lower interest rates and AI and other opportunities, business investment doing okay. And we have fiscal support, most visibly coming from the German government, but also Next Generation EU. There's a lot of Next Generation EU spending this year. So what we're seeing is essentially unemployment remaining very low. And so we still have the European economy growing close to 1%, a little bit below 1% this year. And that's below potential, but it's not massively below potential. And then the third cross-check, and again, we took our time to look in these months, is how's the financial system doing? Because, if we felt a hike could be not work out because of fragility in the financial system, that cross-check also worked out. Banks are well capitalized, banks are liquid, households are not that much leveraged, non-financial corporates are okay. So in other words, the decision to hike went through a checklist, and that's why we said, I think the marketing, if you like, is this was a robust decision. Going from 200 to 225 would be very hard to make the case we should have stayed at 200. And that's fundamentally why we hiked. It's pretty straightforward. It's not too mysterious. With that amount of extra inflation in the system, a measured monetary policy response made sense.
Yeah, of course, here everyone in the room and online knows, fully understood data-dependent and meeting-by-meeting approach. The question is, given what you said and with the experience of 2022, the question is that why you didn't hike already in April the key interest rate?
Yeah, so this is where essentially you have to balance some factors. So of course, for a lot of the intermediation, the anticipation that we might hike in June meant that already a lot of pricing in the financial system had adjusted. So if you like, the extra gain in terms of tightening financial conditions by moving the policy rate in April versus June, there's not much in that. And given the uncertainty about the war and the uncertainty about how much inflation was responding beyond the energy sector to it, we felt we could take our time in order to do the full due diligence. And this maybe goes back to, we have set up a very kind of methodical approach to making monetary policy decisions. And we've gone through 2 big strategy reviews in these years. The most recent one finished June of last year. So if you haven't looked, we have a monetary policy strategy statement. It says, here's how we're going to make our decisions. And it essentially has a checklist. And that checklist could not be completed in April. So if we'd gone in April, I think we said, okay, do we fully understand all of the ramifications? That's one. Number 2 is you may have noticed a lot of volatility in the oil market in these weeks. And essentially, I think at the April meeting, the profile for oil looked very different to the profile we had going into the June meeting. So having, letting, if you like, the system gather its own information about, because remember, over these weeks, there's been many different conjectures about would the oil market hit a kind of a kink where start to be really shortages and so on, how responsive would be supply to the jump in prices, how widespread would be the knock-on effects on fertilizer prices and so on. So I think, taking our time made sense.
And as a good economics, as you are, because you did your PhD in Harvard and you were a professor at Trinity College, so the analytical framework to analyze monetary policy in such a circumstances says make a difference between a supply-driven inflation shock versus a demand-driven inflation shock. So today we are in the first case, supply-driven inflation shock. We have higher inflation, as you said, probably more in the pipeline for indirect price increases. But at the same time, we also see economic slowdown. So, for instance, confidence indexes plummeted in Germany, France. In our research, we expect a small negative, but negative GDP growth in Q2 in Germany, almost zero in France. So how to make the arbitrage between this current situation?
Yeah, I think it's a very nuanced situation because we also saw that decline in consumer confidence and so on. But the fundamental issue, and remember, monetary policy looks out 1 year ahead, 2 year ahead. Across every type of analysis, you would see is that at some point there was going to be some kind of resolution to the war. So yes, until that uncertainty would resolve, there would be this decline in consumer confidence and so on. So let's see what happens now. But basically, the modeling said, okay, oil prices are going to start falling this year. So that phase of the hit to consumer confidence, uncertainty in business indices and so on, that correlates with the war and the uncertainty of where is it going. But everyone I think assumed at some point there'd be some kind of resolution to the war, and maybe we're going to enter that phase now. So we had yes, a major hit to the economy, but then a fairly rapid resumption of not super exciting but steady momentum in the European economy, and that's fundamentally it. It is this has been assessed to be a war that would not take forever to come to some kind of resolution. I mean, again, we don't think it's, when I say resolution, it doesn't unwind what's happened. It doesn't mean the pre-war configuration re-emerges. But in terms of that impact effect on uncertainty and so on, if that had been assumed to remain into the medium-term horizon that's relevant for monetary policy, that would have been a bigger issue. So this, I mean, I think the semantics, by the way, of monetary policy, I mean, yes, there's a very important distinction between supply and demand shocks, but there's a whole family of different configurations there. And this one, which is essentially a pretty big surge, but then starting to reverse, mid 2026, is a very different type of supply shock to a more open-ended one.
And precisely on this point, so in the speech of Christine Lagarde last March in the ECB Watchers Conference, so she described 3 scenarios. So one which is looking through. The other one is a big but not persistent big shock. And the third one is, of course, more persistent and large inflation shock. She made clear last week at the press conference that clearly we are not in the first scenario anymore. So it's between the two, and the second and the third one. And at the same time, there is in phases you made in the last June last year about in the monetary policy strategy, the emphasis on medium-term orientation. So my question is, how can we reconcile all those things with the fact that Christine Lagarde said last week, this is not an insurance or a preventive hike, but at the same time giving the impression that that could also not be the start of a hiking cycle?
Yeah, so I think those of you who have kind of studied monetary economics, if you open a textbook, or if you look at something like a Taylor Rule view of monetary policy, the textbook scenario is essentially what's called a local shock. You've got an equilibrium, you've got a shock that moves you away from your 2% target, but that type in the textbook, it's kind of not too big, not too persistent, but you respond with monetary policy in a measured way. That, if you like, is maybe where we are now. But of course, given what we had to do in the pandemic, and before that, what we had to do when we had chronically below target inflation, we've had two, if you like, non-textbook inflation episodes before this. So the non-textbooks are, one is massive crisis like we have the global financial crisis, other factors where inflation goes well below the target and you approach the lower band on interest rates. So we had a whole machinery about unconventional monetary policy. Then we flipped in the pandemic because that was a very unusual combination of shocks, which meant, the textbook assumption, this is a local shock, it will mean revert essentially over time. We could not rely on that. So that's the third category of, if there's a threat to the anchor, you have to be forceful, some combination of being forceful or persistent. So people now have, what they've experienced are really big dislocations in inflation in both sides. But on this occasion, we're not so far. I mean, let's see where we go. We're not so far in that big dislocation scenario. And we're really reminding people that the textbook is basically, it's not big interest rate cycles. It's, you get a mid-sized shock, you respond in a measured or calibrated way to that. And that, if you like, this one I think is a classic, if you like, monetary policy situation, as opposed to the really unusual ones we faced with the pandemic and the low inflation episode.
But in that context, does it mean that the main goal today is to adjust the short hand of the yield curve to stabilize the long hand?
So, I mean, the monetary policy controls the short end. So we'll always control the short end. But I think what you say captures essentially, but it's one, just I can think of other ways to capture it, which is basically behind everything, you want people to retain total confidence that over the medium term inflation will be 2%. If the market loses confidence that inflation will keep on returning to 2%, then I think the investors in the room are going to start adding inflation risk premium to the long rate. So you will lose, the long rate will go up if we don't do our job by being, if you like, proactive with the short end. So absolutely, that is the exactly the goal. But I mean, with the phrase about inflation expectations, it's important. This is not some kind of extra exogenous type mechanism. I mean, people understand how inflation works. And essentially by tightening financial conditions, we don't want to kill demand, but we want to make sure that demand is sufficiently moderate, that people have limited ability to kind of pass through the cost increases that are happening into final prices. So it's to kind of moderate and curtail the transmission of the cost shock into consumer prices.
But it is not more difficult today for this transmission between the short end of the yield curve to the long end of the yield curve, in a context where we still here and there see fragmented markets? What is your view?
So I mean, we again, for years now, what we've said is our monetary policy decisions will be based on three layers. One is we have to assess the inflation outlook. That's the most likely path, but also the surrounding risks. Number two, we're humble people, so we say, okay, that's our forecast. Let's cross-check what's actually happening in the data. So this concept of underlying inflation. So by the way, by the June meeting, there was already enough evidence that inflation has moved between March, April, May. And we looked at the underlying component. We said, okay, it looks like this is going to be in the system for the next year. So the underlying inflation is a kind of empirical cross-check on the forecast. And then the third criterion is the strength of monetary transmission. So exactly, we want to take into account in any given period, you could have other factors tightening financial conditions. And so the calibration of what we do at the policy rate takes into account those other factors. But I would say in the grand scheme of the last 15 years, the kind of transmission now these days is a lot smoother. What I said earlier on, we now have very well capitalized banks, liquid banks, and there's a big payoff. I mean, I think you've, especially here in Paris, sometimes hear some people say banks, should maybe, there's some people in the European Banking Federation make the case there should be less capital in the system. Highly capitalized banks, highly liquid banks mean we can do monetary policy very effectively because we don't have to worry about the transmission via the banks. And in terms of the sovereign debt market, there's been a lot of improvement, much narrower spreads in the grand scheme. And compared to, again, the worst of the crisis, transmission these days is a lot smoother.
So this brings us to the other topic about liquidity policy. Regarding this transmission, right or wrong, few banks have told me that in this context of a very ample liquidity, excess liquidity, they are a bit reluctant to go to the refinancing operations of the ECB, the short term, because they fear to have the stigma after this trauma of the financial crisis 2007, 2009. Do you share this view, or?
So, I mean, I think what's true is everyone has to get used to our new operational framework. What we did 2 years ago when we announced it is we said, we've looked hard and we think we need a hybrid system. So the hybrid system means that we want to have both sides, if you like, of our approach in operation. Yes, we will have a structural bond portfolio, so we don't want to exclusively rely on refinancing. But we also think it makes sense in the context of the EU area especially. But other central banks are also coming to that conclusion. The Bank of England is also well ahead, that it makes sense that a decent amount of liquidity, and maybe importantly, marginal liquidity. So at the margin, if a bank needs extra liquidity, we have fixed rate full allotment. The MRO is 15 basis. It's not super high. The spread against the DF4 is 15. So in that context, what we're saying is banks should basically get used to the idea that this is routine. So to the memory of what happened under a different operational framework and a different circumstance. And again, in a context where, our assessment is banks are well capitalized, highly liquid, that the treasurers, other people involved in banks in optimizing liquidity policies should basically get used and prepare for the new system. And so you've heard from my colleagues, both on the market operations side and on the supervisory side, basically saying banks should prepare, they should test their operational readiness to do it. I mean, it's much further along now at this point at the Bank of England, and it seems to be going okay. So I think just settle into the fact that this is a hybrid system where banks should recognize the value of being able to tap the MRO at a pretty modest spread over the DF4.
Yes. So in this context, also last year in the revision of your monetary policy strategy, the ECB announced that it will adopt two new permanent policy instruments, so namely the structural refinancing operation and the structural monetary policy portfolio. So my understanding is that this is the objective is to maintain sufficient liquidity in the system. Do you have already some flavor, so where we could go, in which direction? I don't ask numbers, but
no, I understand.
if you want to give numbers, I'm happy, but...
No, so I think what we did do, again, is March 24, when we laid out, you can see the press release, we've laid out, I think, is essentially a hybrid framework, where the value of not being exclusively injecting liquidity via the bond market and not exclusively injecting liquidity through refinancing. And often in economics, corner solutions are not the best solutions. You want to find an interior solution with a nice mix between them. But what I would say is there will be a substantial contribution from the structural bond portfolio. But going back to the overall discuss about numbers, because refinancing will be demand driven, maybe the whole point of this is we will let the banks decide the marginal contribution from refinancing. It's fixed rate full allotment at 15 basis points above the DF4. So of course we will be looking at how is this playing out. There's going to be, we'll be working on our internal thinking. We'll be observing what's going on. I mean, liquidity is still, there's a lot of liquidity still. So there's not a huge amount of banks going to the MRO. But over time, this is going to happen more. So, to me, it's a kind of maybe a dynamic process in terms of working out the relative balances between those two.
Do you agree that in an excess liquidity or liquidity surplus environment, of course, the central bank is never sure to be able to withdraw liquidity in the market when she wants those. So then that could create volatility in the money market interest rates. But then do you agree that we should have to keep stable and low and without volatility the short-term money market interest rates, that we need to have a sufficient amount of excess liquidity?
So, I mean, the operational framework is clear, and it's important to go back to the foundations of it. We say we're going to steer the money market via the DF4. That some amount of, because refinancing at the margin will be driven by the decisions of banks, that some amount of volatility in the money market will be tolerated, but of course there's a limit to that. So this is again, we will have to see how the system develops. It is a new framework, but as I say, we do think it balances different objectives. So I think this I think is where a lot of central banks are going, because it's unsatisfactory to be like a bond-only approach. It's unsatisfactory to be a refinancing-only approach. And this hybrid system, I think, makes sense.
And among the new instruments the ECB has adopted in 2022, usually the ECB announced to have this new crisis tool, the TPI, Transmission Protection Instrument. How, in the current context, how do you see this instrument working or not working? Under which conditions you will see the need to activate this instrument, which also will contribute to the excess liquidity?
Right. So I'm going to go a little bit back before that decision and then a little bit forward after that decision. So going back before that decision, I mean, the grand narrative of the creation of the euro and so on is when the euro was created, it was incomplete in the sense of crisis management tools were not laid out ex ante. So crisis management tools were basically ex post retrofitted onto the system. And before you get to the role of central banks in terms of crisis management, you do need the articulation of the crisis management framework from a kind of fiscal point of view. So, of course, there is the whole ex-ante fiscal discipline framework, the fiscal rules, the role of the Commission, and so on. So there's that. There's the push, big push, an important push, with this single supervising mechanism and the reforms of capital and liquidity ratios to make sure that the banks are not a source of instability. And again, where we are now with high capital, good liquidity, very important in terms of the overall crisis management framework. And the reason why I say it's a sovereign issue, it's a bank issue, because of course there are doom loop dynamics between the two of them. Then you need the question, what happens if a sovereign faces a solvency issue? And that's where the ESM was created. Again, ex post, not before the crisis, after the crisis. So we have the ESM, and then hand in hand, if you like, with the ESM, we have OMT. So if we have a country that does go to the ESM and you have public official funding to help an adjustment program, the ECB said back in 2012 that there's a role for OMT in bridging essentially liquidity through that. So that's where we were. But that was incomplete because there's another crisis scenario which is essentially market panic, if you like, or unwarranted volatility in the financial markets. And that's what TPI is about. And a lot of value is ex ante. Because there's been many models written about the euro area. Remember, the big issue with the euro area is you can substitute out of a sovereign without taking currency risk, because you can find another European sovereign to go to. So there's an inherent elasticity in demand for sovereign bonds in the euro area. That's not true for a single sovereign with a single its own currency. So this is why we designed TPI. I think it's a very good idea. But the most important attribute is ex ante. So investors know, do I have to worry about the fact that the euro areas may be more fragile to unwarranted speculation than other sovereigns? And the answer is no. I can see that the ECB, if there's unwarranted speculation, can play a role. We followed that. So going forward, in the 2025 review of our strategy, we expanded or refined our articulation of QE. So we expanded and said, look, we can do asset purchases for two reasons. One is for inflation targeting reasons. If inflation is too low, we've run out of room in terms of rate cutting. Doing bond purchasing can play a role. But we also said we can also recognize that there's a role for asset purchases in protecting the transmission of monetary policy. I mean, other central banks articulate this as basically a kind of market stabilization role for QE. And this is like the Liz Truss episode with the Bank of England. And the reason why that's different is, of course, you intervene when essentially the market is panicking. When the panic is over, then whether you need to maintain the balance sheet at the same level is open to question. So, I think TPI is very valuable, but we gave you the complete answer in the press release. We gave you exactly the conditions under which TPI would be triggered in the press release, but unfortunately, it's a conceptual answer because it's very difficult ex ante to kind of. It's not a good to say, well, here are the numbers, or here's the exact scenario, which is unwarranted versus warranted. We said we're going to look at the sustainability analyses of IMF, ESM, and so on. But we've also said we'll use the work of the ECB staff and our judgment. So it's a judgmental answer, I'm afraid.
But that's an important point because I'm not sure this is fully understood by everyone. So the point is, today public finances in the euro area are not great, but at the same time nobody sees a solvency issue. That being said, most countries are under EDP, the excessive deficit procedure. So could we imagine a situation where there is a market stress, which is not the case today because the TPI being not activated plays its role as the OMT in 2012. But can we imagine a situation where there is a market stress for some reasons, and you have this most countries under market pressure still under the excessive deficit procedure. So what could be the action to move to this combination of ESM OMT, or there is some room for activating the TPI?
So countries are in an excessive deficit procedure. I mean, what's critical is that they have a plan to get out of it. So, what's important is essentially, is there a credible pathway to basically fiscal sustainability? That is the critical issue. The Commission's framework is very clear about what happens if you're in excessive deficit procedure. But it basically boils down to you need to have a credible plan to improve your situation. So it's very important, that we basically have this kind of laser focus on sustainable public finances. And so, I mean, again, if you take a global perspective here, I mean, of course, people don't like the bureaucracy of the European Commission's framework, but it really does provide an anchor. I mean, compared to, again, look around the world, countries which only have a domestic fiscal anchor, that's very difficult to sustain. I mean, it's important to have a domestic fiscal anchor, but to have the European framework where essentially there's a lot of peer review, there's a lot of critique, there's a lot of pushback. So in terms of providing an important anchor for sustainable public finances, I think the European system provides a lot of safeguards there. I think it's very important at all times that governments have a credible and consistent story about how whatever shocks they've suffered, pushing them away from low public debt, how they will navigate that. And that's super important.
And do you see any hope or prospect to have more ambitious budget for defense, for investment in innovation at the European level to alleviate a bit the pressure on national budgets, or you are pessimistic?
So I would slightly separate the two things. So one is it's very important within the kind of national fiscal debates for those countries which do have essentially a strategic need to increase defense spending, for example. That's very important, and you see it in, especially I think in the Scandinavia, the Nordics, saying at least to some extent this has to be paid for either by cutting back on other spending programs or by finding new tax revenues. But there's also clearly a case for European action. But remember, the European Commission, I mean, there is joint borrowing, I think, of about 150 billion to help, if you like, refinancing. So there is a kind of support already, significant support, to help countries meet their defence requirements. Remember also the 90 billion EU loan for Ukraine. So, you know, there is more and more the recognition of having the value of commission level issuance is important. It does take away some of the marginal funding issues. But if your question is there also scope for more, you know, common debt, which is backstopped by common fiscal resources? Clearly, I mean, many people are interested in that question, including me. What I'd phrase there is subject to finding the political agreement. And that's always important. It's not just a technocratic issue. So to say that there's value in common debt, you can make the case, but also it has to be done on a kind of a basis where the European member countries accept, you know, endorse it, because it's not a free lunch. If you look at the Draghi report makes the case for more joint issuance, but it also is clear it means more fiscal discipline at the national level. To make room for more joint issuance, you do have to have essentially more constrained national fiscal policy. So no free lunches, but a potential for collective gain.
So now looking forward, another important issue for investors and issuers is the natural rate, so natural interest rates, or R star and so on. 2 years ago, the former French governor, François Villeroy-de-Galhau, said that, well, he believes that the natural rate was in the range of 1.5% to 2%, saying also that for him, it was closer to 1.5%. Was it the view of the Governing Council, and if yes, what is the view today?
Okay, that's an important question. So I do agree, and again, for you know, the bond investors here who have to take the long view, it is how we think about the natural rate. Let me say before I give you some numbers, it's basically, if you like, the anchor of the system. So basically, when all shocks fade out, it's the asymptote. That's important if you're trying to think about 5 years ahead, 10 years ahead. But of course, when you look, you know, over the near term, I'm not seeing a no-shock world. So with that caveat, this is about where the system settles down once all the shocks fade out. We do regularly look at this question. So I think in early 2025, the staff in the ECB bulletin put out a set of estimates based on a range of models. So those models, some of those models are basically macro models. So those macro models look at the joint behavior of GDP, inflation, and interest rates, and infer from that joint behavior what is essentially the underlying attractor, if you like, for the interest rate. A second way we go is surveys. We ask professionals, you know, especially the monetary analysts and so on, what do they think? And then the third way we go is by looking at the yield curve. So again, that's real money. That's what people are putting their money on in terms of what they think is a good price for a long-term bond. So ECB staff, and in turn me, who received their work, I'm not personally running the econometrics. So I'm going to say, according to the ECB staff, in early 2025, what they had as a range was 175 to 225. So in March this year, I gave a speech and I updated that. And in the update, the range now is 175 to 250. So there's some reporting yesterday when I talked about this in a different event. So first of all, I mean, there's nothing new in the sense that this is coming from the start of the year calculations I showed in the March speech. But maybe importantly, because again, we want to keep an open mind about which of these models are important. More or less, the macro models find results at 2 or below. The surveys of experts are concentrated around 2. What is true is the yield curve models have drifted up a bit. And that's why we say the upper end of this range is 2.5 now. But again, for the bond investors here, the question, and in the speech back in March I wrote about this, is what has driven the fact that the 10-year rate has gone up a bit over the last year or two? Is it the expectation that policy rates will be higher over the next decade? Or is it a term premium of various types? Because from a point of view of trying to predict where is our policy rate going to go, it's very different if essentially people believe there's going to be upward pressure on the policy rate, or they believe the yield curve is going to be steeper. For me, given the mismatch where the macro models haven't moved, and that the yield curve analysis has moved up a bit, I mean, there's lots of reasons why you might think term premium have gone up, including for global factors. So if you put all of that together, it's still a pretty narrow range in the debate. It's lower than, I think, the calculations for the US and so on. But I think that's natural in the context of the different level of growth dynamics in the euro area compared to the US. And again, super interesting debate, especially for bond investors. But it's not the center of the current policy discussion, given that we're dealing with shocks. We're not dealing with the no-shock steady state.
But from your view, this potential increase of the natural rate, what could be the reason looking forward? So expectation of productivity gains, or if you take the model of Lombard, Williams, that could also be a structural shift of investors in favor of risky assets. So how you disentangle those potential increase?
Yeah, so again, for those who may not totally follow this debate, there's basically two main theories about why the natural rate, the kind of long-run steady state for the interest rate has come down. One is basically it's just the productivity trend has come down a lot. Also, by the way, population growth has come down a lot. So total GDP growth has come down a lot. The other view, especially after the global financial crisis, is people really wanted safety. They'd been burned by investing in property markets, in bank shares and so on, and they just wanted to hold super safe assets. So in principle, you can ask, well, what could reverse those trends? What could reverse the trend in GDP growth? And again, if you think about total GDP, demography is not particularly exploding. But then in terms of productivity growth, one of the big issues, of course, is AI. And my speech back in March was about AI. And that was the context where I came back to the interest rate. But there, one of the open questions in that debate is the interaction between AI and distribution. So AI might, I'm an optimist, I think it will increase productivity growth a lot. But if the gains to that are concentrated among a very small group of people, and if for lots of people in society, they face a lot of uncertainty about their futures in terms of occupations and income, you could see a lot of precautionary saving going along with AI. So let's see the impact of AI on the future. And then in terms of the attitude to risk, I think that maybe there's something in that. What we saw, by the way, when we raised interest rates and the market very quickly in early 22 had a big change in their view about the 10-year rate and so on, is European investors, of course not everyone, but there was a noticeable shift out of bank accounts into the bond market. So there is, I think, some degree of more interest. And with Savings and Investment Union, and just by looking by way of contrast of the capital gains earned by US households compared to European households, as European households get richer, more educated, financially educated, there could be more of that. Now, how big that effect is, let's see.
So, partly related to this issue, the last topic where I wanted to discuss with you before opening the floor to questions from the audience is about safe assets. So the market is there is market appetite for more safe assets, so that's part of the explanation of the success of the bonds issued by the European Commission in the context of next generation EU. Although this is not perfect, because normally on paper all those bonds should be reimbursed in 2058. How do you see this discussion at the European level going forward? That's my first question. So do you think a proposal like the red-blue bonds plausible in the near future? And the second question is that is the answer for more safe assets and a proper common Eurobond is not, the solution is not with the ECB, because could we consider that at some point if the ECB issued ECB certificates backed by the sovereign bonds they accumulate over the crisis, over time, that would be the de facto safe asset?
Okay, there's a lot in your questions. So let me run through this, because I've been involved in this debate going back to around 2011. So first and foremost for everything is all of this is a lot easier the safer are the assets of all European sovereigns. So the debate can be much more advanced now when essentially all of the European sovereigns, well, with some maybe exceptions, but all the European sovereigns look a lot better than they did 15 years ago. So elements of that are, it's been proven that European governments were prepared to do significant fiscal adjustments. So there's a kind of a narrative globally about it's very hard to find cases where countries do fiscal adjustment, i.e. that improved their fiscal standing. Now, with the help of the official lending and so on, it happened in Europe. Going back is, as you know, a lot of fiscal events were triggered not from original sin in the sovereign market, but coming from banks that had to be rescued. So when the macro fundamentals are better, when the banks are better capitalized and so on, the assessment of essentially the fiscal sustainability of European countries has improved a lot. So number one, having more European governments with low yields is important. And number two, there's greater symmetry in the European system now, because essentially with the very large current account imbalances, banking sector imbalances and so on, it's difficult to do joint issuance when you have asymmetric circumstances. So having more symmetry in the European configuration is very important. So I think, yes, I've written several speeches where I say, and again, the most important precondition is subject to political agreement. This has to be the precondition. So there needs to be like a technocratic debate like we have here, but there also needs to be the political debate about, okay, what exactly are we talking about? But let me say, and that's why there's several tracks here. And I think, as I mentioned earlier on, from the Commission point of view, they've done the Ukraine issuance, they've got the defense issuance. I think over the 2028-2034 horizon, they have ideas, under the crisis mechanism, ideas of the Commission, 350 billion. Under Catalyst Europe, 133 billion. So there are ideas for European Commission issuance. But there's also, I think, a related conversation, but a bit different, about what can the national sovereigns do collectively. And the blue bond, red bond idea is essentially, if you have a mechanism that basically retires some fraction of national debt by issuing collective debt, then that can be a collective gain. So the Blanchard-Ubide version of this last year was 25% of GDP. If you take a 4% yield on sovereign debt as a kind of, to add a buffer to where they are now, you can service 25% of GDP with, at 4% interest rate, 1% of GDP in tax revenue. So for this to work, you would need to raise the European common budget from 1% of GDP to 2% of GDP. That's not the United States of Europe, where the federal budget is 20% of GDP, but it is a doubling of shared fiscal resources. So the debate has to be among European governments. Are we prepared to ring fence 1 percentage point of GDP of tax revenue that basically goes straight, to, if you like, to the whoever is issuing this joint debt? And there is a very well articulated possible collective gain from that, but all of it turns essentially on that agreement. And it also turns, because that means there's 1 percentage point of GDP less available for national debt servicing, the national governments have to recognize it does mean less scope at a national level. So again, no free lunch, but very intriguing. And let me also advertise, there's yet another mechanism which I was involved in designing called sovereign bond-backed securities, which is basically, again, repackaging the existing amount of national debt and creating safe assets through tranching. So I think there's also value in that. It requires less in terms of fiscal integration. And all of these ideas should be continue to be looked at.
Thank you. Thank you very much. So we have some moments for Q&A. So this is a unique opportunity to ask a clarification you may have from Philip. First question, there is, I see, yes, just over there.
Hi.
If you can just introduce yourself.
Yes.
And the institution for which you work.
Sure. So I work at Natixis. So my name is Olivier Lecoutre. I'm a market maker on EU bonds. So I'm very interested in this topic. And you to come back on this last point, you do mention the political willingness to issue more EU debt. It seems a bit difficult. We touched base with it with Monsieur Lombard yesterday, who said the unwillingness from the German to issue more debt, and obviously also touched base on the high indebtedness of some European countries, France and Italy. And so my question to you is we should have some difficulty to have some room, fiscal room to a response to future shocks. You know, we just came back of the COVID and Ukraine crisis, and now the Middle East crisis, and potentially some more crisis in the future. And if there is not that political willingness to have some more EU debt to respond to these shocks, and not the capacity at domestic levels, what is the response for the ECB? Because obviously your sole mandate is inflation, and unlike the Fed, you don't have an employment mandate. So what could be the response if you have still decently high inflation, but the potential shock in the future?
Unfortunately, I can't really. It's a super interesting question, but it's such a all-embracing hypothetical that I don't think I can give you a straight answer on that. But you've identified a set of issues. So again, I think we observed I think at a technocratic level, I haven't been making speeches over the last year articulating the case for more joint debt, but I try to be clear. It does require that political consensus to move forward on that. So what I would say is, and what we say basically, maybe we're unusual among the world central banks that in our monetary policy statement, we always have a paragraph about essentially what governments should do. And essentially, a lot of that paragraph is essentially saying we really recommend. It's a two-sided approach. One is, which is everyone can see, Europe really needs to boost the growth rate of the European economy. The Draghi reforms, Letta reforms, etc. Because so much changes when you can point to a higher growth rate of the economy, including relaxing fiscal constraints. And then second is essentially advocating that European governments follow the fiscal framework. This is, by the way, why the reforms a couple of years ago. Now, of course, so many events are going on that the reforms a couple of years ago in the fiscal framework are not, the day-to-day prominent discussion. But the European governments did sign up to essentially fairly demanding debt stabilization strategies there. Now, a lot of them have 7 years to comply, so it's not visible yet, in fiscal, the annual fiscal decision. So this is going to be a big issue for the coming years, is that race to recreate national fiscal space is going to be very important. We have a primary mandate of price stability, of course. So I think we will respond to what we see in front of us. But the basic message being countries need fiscal buffers, and rebuilding those fiscal buffers is so important, which I think is appreciated by finance ministries and finance ministers. But of course, it's a big struggle in terms of parliamentary debates and popular opinion to make the case for that.
Another question? Thibault?
Yeah, hi, I'm working at Natixis CIB in the research department too, in charge of sector and credit research. So I have two questions for you. First of all, on the fintech side, how would you see actually the fact that European fintech are scaling up and acquiring banking license? Do you see it as a threat actually to European banking stability in the medium term? Or otherwise, do you think it might actually push for cross-border consolidation in the European banking sector that we are still actually lacking. And my second question is about the cross-border consolidation versus the domestic consolidation we have seen in the European sector. Do you see it as differently, if it's domestic or cross-border, in terms of consumer lending, credit supply, etc.? Do you think it's potentially a positive rather than a negative when it's cross-border? Thank you.
Thank you, I mean, for raising these important issues. So again, last year in our strategy review, we basically said, this is a big decade. So the 2025 strategy review basically says, what are we going to be confronted with out to 2030? And changes in the financial system are one of those issues. So, you know, I think, honestly, I mean, I'll use it for like platform neutral. I mean, what we think is no matter what type of organization, is it pure fintech, whatever, if it's going to provide financial services, it has to conform like everyone else to all the regulations of financial service providers, both in you know, liquidity, solvency, but also customer service and all of that. So some of the, you know, historically, and of course the banks have to respond, and they are responding by co-opting them, coming up with rival products. But fundamentally, and you see it everywhere, there's definitely a role for pure online banks, which don't have the, now they're going to have a different business model, and we like having a multiplicity of business models and so on. So fundamentally, you know, I don't think it changes the fundamentals, and we should let, you know, if there's technological gains, you know, we should appreciate that. Then the interesting questions about consolidation. I mean, more or less, my personal view is we're living in a world of a lot of fixed costs. The optimum scale of many activities has probably gone up. To run a kind of a safe cybersecurity system is probably expensive. So, but it can be mitigated in the sense of smaller banks using very good service providers who are doing it for lots of banks. So whether it ends up being, we have a relatively small number of gigantic banks in Europe, or essentially you have a lot of front-end banks who understand their local customer segment and so on. But at the back of that, there's a lot of integration in different processes and so on. So the industrial structure of banking, but I do think from a macro point of view, it's very important to have the risk sharing that comes from cross-border banking. That can be in terms of equity ownership, it can be in terms of funding, it can be in terms of common technology. So there's many elements to that, but absolutely having a banking system that is too localized and in turn too intertwined with its domestic sovereign is not a good recipe.
Maybe one last questions. So maybe from my side to end this discussion with a European touch. How do you see, looking forward, the discussion on the savings and investment union evolving, given the fact that we see there are some reluctance or some pushback from governments to complete the banking union? Are you optimistic?
So I think there is momentum, including on banking union, and because you know, again, coming back to what I said earlier on, Europe needs to grow more quickly. That's not just kind of improve the living standards of people; it's also geostrategic. Because in order to be autonomous and sovereign, I think it's important that you don't fall behind in terms of technological frontier and so on. So clearly having more risk-taking finance in Europe would be a good idea. Finding ways to encourage European households who hold too much money in their bank accounts and not enough in investment funds of different types. That's important. It's important behind everything to promote the single market for goods and services, because you're not going to have firms that get to the scale that it makes sense for them to do IPOs and makes sense for them to do big bond issuances if they're constrained by the size of their national market. So these all interplay. Savings and Investment Union, because there's many different sub-elements within that. It's important that the momentum is there. So I'm optimistic. I do think there's been a real shift. Governments can see it. It doesn't mean everything becomes, the perfect overnight, but I do think there's significant momentum.
Thank you very much. That was thank you for this very insightful and inspiring discussion. I think Thomas wants to say a few words.
Yeah, no, I mean, thank you very much. It's an honor to have you with us for our SSA conference. So I think now we'll do the last one-on-one session for us. So we have 2 slots. After that, you're all invited to a lunch. Thank you again, Alain. You have done a tremendous job for us this year. I hope we will all see you next year for the next conference. Enjoy the last day. Thank you very much.